tell me about, as you all were working together, how that conversation went in terms of thinking about starting MBM, and like we'll get into what you all do, but just curious, like the genesis story there.
Sure. This was back in 2013, 2014. Arun and I were at a pretty atypical venture fund. It was all partner capital. We created companies ourselves. We hired founders into the businesses, and we were essentially funding these businesses on an ongoing basis. So we had kind of a low basis. We had control on these companies, and we were in them. Payroll was going out every 2 weeks. It was our money going out the door. It gives you a very different mentality about what you want to see happening in these companies. You have like a real sort of owner-operator mentality. There was sort of a sense of there will be no zeros in this portfolio. So kind of out of the gate, it was a very different venture fund, and we were deeply involved. We were deeply operationally involved. And Arun and I worked together. I was on the operating side as a GP. Arun was the CEO, was brought in to be the CEO of one of our companies to turn them around. Probably one of our most challenging that he was able to turn around. We worked together on that. And one of the things that we came away from that experience with was really like the middle tier of a venture portfolio gets completely ignored. For us, we saw great value in kind of a middle tier of venture portfolio. So companies that have a great product, have real revenue, they're growing, but they're not going to be the big winner in a venture fund portfolio, and as a result, they kind of get ignored. And for us, we saw that those were great companies, and we could kind of get into those companies, we could grow them sustainably, and we could exit them for great exits. Not billion-dollar exits, but meaningful exits. And so over the next 10 years, we really spent time kind of looking at those kinds of companies that fell out of kind of the traditional venture model, that were really great opportunities and just needed kind of like another chance and to really get into kind of a profitability focused lane and out of the unicorn or bust sort of binary framework.
Yeah, and tell me why do VC funds, just for those, most of the people in the audience are founders. Many are first-time founders, so many haven't been investors. But can you help illustrate why a VC fund is focused on those unicorns? Why is that their model in terms of the returns they're looking for and where they pay the most attention, and why they would ignore or not pay attention to good businesses, but maybe aren't going to be unicorns?
Well, I'll take the second part before we go to the first part. So a lot of the businesses that we like are good businesses embedded in like a bad business. And that's partly because of the venture model. So the operating expenses are too high. They're not run as a bootstrap company or a profitable company like a fund. And so we see a lot of opportunity in that. If you're not going for this massive 100% year-over-year growth, which is really hard to do, then you might reimagine the business. It might be a lot less stressful, and you can kind of grow over time, right? Growing 20% a year is still really hard. It's like 10 times GDP, but it's much more achievable, and you're not stretching for that incremental dollar of revenue. So I just want to make sure that that they're good businesses embedded in these bad businesses. I think from a venture model, if a venture fund is investing $5 million for 10% of the company, and 90% of their portfolio is going to fail, they need to be writing tickets, writing checks, where that $5 million turns into $500 million. And so the only way that they can achieve that is to really put a lot of pressure on the company to grow. They need to increase volatility so that they can achieve these outside outcomes in one or two positions in their portfolio. And from our perspective, that's really rough sitting on the other side. We think that you don't need that volatility, and you can kind of grow in a more measured way.
Yeah, and to just dive into that point a little bit more, they need those returns to be at that scale. So they're not pushing their investments to build solid foundational businesses because it's either, a home run or nothing for them, because it doesn't fulfill how they're trying to make returns. Would that be fair to characterize?
Exactly right.
Yeah.
Right. So it's like sort of the power law.
Yeah.
So if you invest in 10 companies and you know that 7 or 8 of them are going to be a zero, then the other 2 to 3 have to be like 10, 12, 100x, right, to kind of overcome that and still get great returns. And so that's when they see a winner, they have to kind of like all skate to kind of where the winner is. And so it's rational, it's highly rational. But as a result, some of these other companies that are sort of in that middle tier that are not going to be 100x get sort of left behind.
Yeah. So let's dive into your business model and what you look for. Maybe to start, could you just plainly talk about what types of companies you're looking for, what type of returns you're looking for, and some of the criteria that make a company attractive in your eyes?
Sure. So I'll start. So generally, we're looking for companies that have 3 million or more in revenue, in areas of fintech, HR tech, SaaS, data. I would say digital e-commerce. So stay away from physical products, and we'll stay away from anything that I would deem to be hard tech. So FDA related, deep tech, DevOps. And anything that we kind of sense does not have product market fit. So I think the recognition from our side is that it is really hard to go from zero, right? And we're not 0 to 1 investors. They're guys that do that. Founders take a lot of risk. And by the time you get to 1, which is where we come in, we want to see that the swing has been completed and maybe there's just a different trajectory. And that we can be helpful. I think the other thing that I'd add there is for the companies that we're investing in, generally the plan is to put growth capital on the balance sheet. We are growth investors, so we're not like looking to buy a business and just kind of run it down. But we want to make sure that there's alignment with the teams that we're working with, that we're going to grow in a measured way. That we're going to kind of manage budgets and kind of. It's no longer a venture mindset. It really is a private equity mindset.
And how involved are you as you make those investments? So in that model, are there you and people on your team who are pretty active in reorganizing or redirecting companies once they've kind of made that turn?
I would say very, very involved. We work extremely closely with the management teams, especially in the first, call it 3 to 6 months, when we're trying to kind of round the turn of getting out of the venture lane and getting into a sort of profitability focused, sustainable focused lane. That's hard. It takes money, it takes expertise, and so in that period of time, we are extremely involved. In some cases, we'll play executive roles. We will take on specific special projects. We will run searches for management for specific members of the management team. We get very, very involved because that's the thing we know how to do really well. It's like round the turn on venture to kind of profitability, sustainability.
Got it. And when you think about the companies you have invested in, what typically has been the lowest hanging fruit to, I don't want to say fix, but reorganize to put them on this different track in terms of where they're going? Is it been about reorganizing like team structures or product strategy or, I don't know, what aspects? Is there any trend in that, or is it kind of every company is a little different?
Yeah, it's definitely I would say talent and go to market.
Mm-hmm.
So usually that's like, oftentimes we work with founders who are like, I was just saying this earlier, I've hired the wrong head of sales like 3 times, right? And they're like, I know I need like someone else. I've been playing that role for, the last 2 years. I know I'm not the best at it, but I haven't been able to find somebody else. Like, I need someone to help me with that. We're like,
Yeah.
Great, we've done that 15 times before. So that's one lever, which is getting the right talent in the right seat. Oftentimes people are playing too many roles, they're not the right people in the right seat. The other is go to market, and the low-hanging fruit are stuff like, in the name of having that like huge exponential growth year, they're going after just like all new verticals, low margin clients, spending tons of money, and we sort of ratchet it back to focus on the thing that you're kind of the best at.
Yeah, got
Those
it.
are sort of the 2 big ones.
And when you think about the analogy you use or the kind of characterization of VC firms, it's like taking 5 to make 500, or in their portfolio 7 or 8 might be a wash. When you think about MBM Capital, how would you use that same analogy? Is it taking 5 to make X, or how many do you expect aren't going to make it? Just so people get a sense of like what type of returns you're looking for and what type of probabilities you're looking for there.
I would say our expectation is every single portfolio company will make it.
Mm-hmm.
And that's the expectation that we go in. It's actually really good for founders because they know we're in it with them and that we're going to build it to a good exit. That's going to be meaningful. It's not going to be yachts money, but
Occasional
who
yachts.
who wants a yacht
Yeah.
anyways? Like,
Yacht rental.
Yacht rental.
Yacht rental. Yeah. Well, one day a year. One day.
Yeah. One day.
From a portfolio construction standpoint, where a VC might say, look, 1 in 10 is going to be a good outcome. Our view is 10 in 10,
Mm-hmm.
but we're also not looking for 100xers, right? Like our view is that we're investing in businesses that are good, small to medium-sized businesses. That is the ceiling of these businesses. And that means that there's going to be an exit in the $25 to $100 million range, $25 to $200 million range. That is still very hard to do. I don't want to make that sound like that's easy to do. But that is a lot easier than $1 billion.
Yeah.
A lot easier, right? They're more strategic buyers because it's not breaking the bank to buy $1 billion company. I used to do a little bit of work with TransUnion as a good example. For them to buy $1 billion business, the thing has to be making $100 million a year. It has to make $100 million a year, not revenue, right? But you can sell a business for $25 or $50 million, and strategics might pay a premium because they kind of see, hey, I can plug it into distribution, I can do some other things, but they're only going to do that if the business is of some scale. And so that's really, like, as we think about opportunities that we really like, we see a lot of businesses that have gotten from 0 to 1, right? They're at 3 million, 4 or 5 million of revenue. They're not quite at scale. But if we can get it to 10, we can right size kind of the team. Now it's kind of cuspy scale, and it becomes interesting for strategics.
So take me through a little bit about how, John, do you have it?
I was going to ask you a question about the founder dynamics when you're going through that.
Oh, I
about
hold that question because I was about to get to it. That was a good question. Yeah. First take me through, I wanted to get it because I think that's a very emotional, I'm sure, moment. But if you can walk me through, how does a typical relationship start and work? Just so people can understand how you would start creating a relationship with you. How early do you have eyes in relationship building with founders? And then how long does that process take for you to decide to make an investment?
I mean, we love to talk to, founders and companies as soon as we can. We know that we're kind of a different type of capital, and so what we say to founders all the time is like, we're sort of happy to be your plan B, and that's kind of okay. But we'd like to get to know you as soon as we can, so that if the time comes where we are the right fit for you, we can move very quickly. So that kind of gets to the second part of your question, which is we can close in 30, 45, 60 days. We tend to go deep on diligence, but we can close pretty quickly.
And on the diligence, what are you looking for? You mentioned, good businesses, you want to see that they can be, doubles and triples, maybe not home runs, but what kind of diligence is important to you?
Yeah, I mean, I would just say one thing in terms of, kind of we're a different kind of capital. The private markets are interesting because in the public markets, companies' share price goes up and down. There's no such thing as a down round in the public markets. Companies raise at $40, stock goes down to $27. They need capital for growth to buy a company. They just raise money at $27. And no one's like, the board is like, oh my God, like, our stock was at 40, now it's at 27. So I think the way that the capital markets are perceived and the way that cap tables are perceived, there's kind of this notion that things can only go up. And that's just not the way that life in the world works. So although we are a plan B in the scheme of like the venture ecosystem, I think too many people kind of bifurcate this, but I'd say that, in most of the world, like things go up and down and things get repriced. And what you want to do is make sure that like the capital that you're bringing in aligns with where you want to go, right? And so for founders that still want to achieve unicorn exits, that still want to live the unicorn dream, we're the wrong capital.
Got it.
But for others that are saying, look, I've been in it for 7-8 years. There's a core asset. My customers love me. I need a little bit of help. I think we can grow it, and I think we can have an exit. We've spoken to some strategics, but we're a few years away. That's a really good partnership. And from a relationship standpoint, I forget what the question is. You might have already answered it. Yes, we can close in 45 to 60 days. We'd love to spend 90 days or 120 days, both getting to know the team, because we're really going to be in the trenches together. This is not here's a check and then we go away. But we do a lot of diligence. We'll talk to customers. We'll talk to a lot of the key employees, and we'll want to build a thesis together as to how we reimagine the company going forward.
Got it. And why do you think it is that what you were saying of there's no such thing as a down round? Like, what is it? Just been how the venture scale mentality of like it only goes up, don't ever think about a down round. Is that myth been kind of perpetuated, or that concept been pushed? I don't know. Like, why do you think that is?
I mean, venture capital at the core of it is basically debt, and so a down round kind of like, unless it's like replacing that debt. I mean, it's kind of it's the nature of the type of capital, I think. But down rounds are happening. There are companies that have done really well kind of post down rounds, and so I think there's like a stigma to it that doesn't quite make a whole lot of sense, because if a company is not worth $1 billion, it's worth $100 million, it doesn't mean it's a bad company.
Yeah.
And if it needs capital, it needs capital, right? And so, and presumably it needs capital for a productive outcome.
Yeah, and I think there, just going to the question that I think John was getting at is there must be an emotional moment when someone goes to their safety school or their plan B or marries a safe person or I don't know, whatever analogy you want to use.
Not touching that one.
Yeah. And some part of that to me is, I think our startup culture the last 20 years, people have been indoctrinated to think you need to only build unicorns, or it's that. But very few companies actually make that, and there's some great businesses. It's just like ruined by people thinking it needs to change the world and humanity when it could just like change, some part of advertising tech or some sort of like smaller thing. How have you navigated that as, you've talked to founders and they're hanging on to that unicorn dream and they put their heart and soul. It's hard to feel like something's not quite working, or maybe they need help. That's a hard thing to grapple with. How have you navigated that?
Yeah, I think that's true. I mean, I think for founders, like, this is truly their baby, right? And I get that. It's like very emotional. I mean, and especially if you've been in it for a long time. We talk to founders who have sort of been like negotiating with their spouse about why they're continuing to do it, right? Like it's really in their bones. And so I think they're kind of two paths. One, I think oftentimes when we have conversations with founders, it's sort of like a little bit of therapy for a little while, and that's fine, right? Because I think it is really hard. And what we hope we can offer in those moments is like a partner, to kind of like a helping hand to get us out, right? Like if they're in sort of stuck in a rut, or just in a place where they're not, they're kind of steady and stable, but like no one's coming to help them grow. We're sort of at an outreached hand to help them get to a better outcome. And we don't expect them to like 3x the business in 12 months. We're not asking them to put a deck together that's going to effectively lie to us, right? Like we want to kind of get into the business together and say, how can we make this thing right? How can we get this thing in a good place? It's definitely emotional. In kind of when it works well, it's really a partnership and we're really in it together, and that feels less lonely, because it's a really lonely place to be a founder or to be a CEO. And then I think there is sort of a reckoning around sort of like, maybe there's it's not the valuation that it once was.
Yeah.
in 2021 or 2019. But at least there's like a plan that we can put together that says, okay, here's how we're gonna get there. Like, we're in this together, and this is the step by step to get to a good outcome where you're gonna have a meaningful outcome. And this is gonna sort of, like, in some ways, I think for a lot of founders, feel like a sort of redemption or sort of justification for what they've been spending a lot of time on. But it's much more tangible and tactical than a sort of a hope and a dream.
Got it.
Yeah,
And-
I mean,
sorry.
Just one other thing. I mean, I think just to be clear, like if a founder is weighing a term sheet from Sequoia, as an example, we're not going to be competitive in that situation. So it's not a, the emotion would be like, why are you talking to us? We're going with Sequoia, and we totally understand that. I think a lot of times when we're speaking to founders or their board members or funds, they've raised a bunch of money. The business has gone pretty far, but not far enough or not fast enough. And they've probably run a process. Like, founders are constantly raising money, right? Like we've been in those shoes. And so there's probably been like 12, 24 months of fundraising that hasn't gone well, maybe some bridge rounds. And so, to your question about emotional, I think there was a little bit of like, man, I'm beat. Like, this is hard. Like, I'm trying to push the stone up the hill on this venture path. And like, our path is like, well, you don't have to push the stone up the hill. It's fine. It's just like, but you have to rethink the business, right? And you have to rethink how it's going to be going forward. And it's not going to be like it used to be, right? A company that raised $20 million and offsites in Madrid, like, yeah, that's probably not going to happen until we see real kind of change and progress.
Great. And can you talk a little bit about one of your success stories, or if you can't use specific examples, just like maybe in general in terms, if it'd be good to hear what that looks like.
I mean, one of the companies that I was an early investor in and then invested in as part of a turnaround, we ended up selling to FTX.
In a cash sale.
In a cash sale.
Yeah.
Cash sale, yeah. There were a bunch of investors that wanted tokens, and I was like, take your money, buy tokens. I do not want tokens. I do not know what to do with them. But that company, they started in 2014, had raised about $30 million, and by 2019, the investors had abandoned it. Lightspeed had 2 board seats. They hadn't been shown up to the board for like a year and a half. They'd stepped off the board. But the company had real tech, and it had like a real product. And we led, we brought in about $5 million. We basically overhauled the entire management team. And so the CTO had left. He was like, I don't understand what's going on. He kind of pulled it all together. He was the executive. He became the CEO. Was incredibly commercial. He had built a lot of stuff. He's like, we don't need to run it. Let's go outsource this, which is crazy. Like, I've seen very few companies at that stage that are like, we're just going to outsource this thing that the CTO has built. But he was like, if we do that, we can release 3 engineers. They had a $1 million a year lease that only 3 people were coming into. Because it was, they signed it right before COVID, right before the old team left. So we had to renegotiate that because money wasn't going to come in until that got canceled. We bought our way out of that. Their biggest expense was a fintech, was legal expenses. They were spending $4 or $5 million a year. We brought in a very senior general counsel and brought that expense down. And so like bit by bit, and then the last thing we did was the whole team was very focused on product, and we said we got to open up the BD partnership angle. We spent a lot of time in our portfolio companies thinking about like, how do you leverage partnerships to increase revenue? Like, you don't need to own 100% of the pie. So we did that, and through that, then we met FTX, and then we ran a process and we sold the company. But that was a phenomenal outcome. It was 8x in 18 months on the rescue capital. Everyone was made whole, I think there are a lot of situations like that. I mean, if we hadn't stepped in and provided real operating leverage in those first few months, this thing would have been a zero. I mean, they're like everyone had walked away.
Yeah, everyone's got a good story to tell when they got their money back. And
Yeah.
I think it's interesting because it's probably a systematic, stack ranking of the things that could just be tweaked, and fresh eyes,
I mean, a lot of
experienced
it was common
operators.
sense,
Yeah.
and a lot of it was, Zach, who was running the company, he was just like, "This is my company. If I owned it for $1, what would I do?"
Yeah.
That's like one of those things. He's like, "Well, I do A, B, and C." It's like, well, why haven't you done that?
Yeah.
It's because my board was telling me we needed more engineers and we needed, this thing and that thing. So it was very much a common sense approach that was executed.
Got it. And how are you meeting these founders? Is it coming through other venture funds that, hey, they've got these companies and are having a hard time raising, or are you meeting founders directly?
Founders directly for sure.
Yeah.
I think as word sort of spreads about what we do, we talk to founders all the time. That's a big source of opportunities for us. Definitely venture funds, where they say, "Look, I love this company. I love the founder. It's not in my top 3, so I can't continue to be involved, but I really want it to succeed."
Mm-hmm.
And lenders too. A lot of venture lenders. Who similarly look at these companies and they say, "I love the fundamentals of this business," but they've got to kind of they need a little help operationally.
Great. I want to ask a couple questions, just general advice. You all have been investors and operators, and then we'll open it up to the audience for questions. So get your questions ready. Maybe just some general advice. A lot of times I meet founders, and we talked about this earlier about they've got a great idea. It's not a venture scale idea, and they can't quite bootstrap it. What are the sources of funding that you recommend to those people as they want to build solid businesses? And they might even be tech businesses, just not venture scale businesses.
Well, so it depends on the stage of the business and what the businesses do. From what we've seen, or at least I would say from what I've seen, customer funded businesses do really well. So if it's enterprise and you can get, you're solving an issue for G. Meisner, and you can say, look, we're going to run a POC, and that POC, kind of helps you build the product and get some traction. I think that's really, really valuable. Once again, depending on the scale of the business, venture debt is an option. If you get to a certain size, we're an option. I mean, we're not looking for companies that have, if it's $100 billion TAM, you're going to have a lot of competition and a lot of well-funded companies. And so, some of the things that we've seen where we've said, wow, this is kind of interesting, are companies that thought they had huge TAMs. They've been at it for a while and they've refined their TAM to say, look, it's not a huge TAM. It's going to be a $600 million TAM. Well, that's great. You could actually build a really good business in a $600 million TAM, and you might not have a lot of competition there. And so you can grow slowly. You can get some customer funded because no one else is solving that pain points, right? It's so niche. And there are ways to kind of generate non-dilutive capital when you're playing in that model.
One last question before I turn it over to the audience. You two are in the unique position where you see a lot of founders that might have made mistakes along the way. So you have a lot of data points to look in hindsight of things they might have done differently. I'm sure there's some situations where, hey, just the market didn't play out. But what are some of those lessons that you consistently see that you would pass on to some of our founders here who are just starting their companies or just starting to raise that will help them not get into those traps? I think one thing I heard was about where you're getting your advice and how much you're doing some blitz scaling in a way that might not be right for your business. But what are some of the other pieces of advice you would give?
Well, one thing that we see a lot, obviously we're looking at companies that have, they've kind of, they're hitting a wall in terms of fundraising or they need capital, is they're not being decisive fast enough in terms of downsizing. And so what we hear often from these companies is that, well, our venture investors that are sitting on our board are asking us to kind of keep this entire thing intact, waiting for a strategic investor to come in to buy the business. And we just see kind of like that process kind of delay decisive change, reimagining, downsizing, which ultimately puts incredible pressure on the business and reduces runway. So one thing I'd say is like, if you were kind of in this situation, you're 12 months or under in terms of runway, you're starting to see macroeconomic issues like, downsizing faster and extending runway, conserving cash, like that should be a top priority.
Yeah.
Yeah, I would say almost no one says I cut too much.
Mm.
Yeah.
Yeah.
Almost never.
Yeah, and no one ever regrets it. Do you think that is a lot because of the emotional factor of like they're hanging on to hope that they're going to keep it intact, like you're saying, or is it tough to, that's like a mini defeat of saying like, oh, if you cut and like people, maybe the press will know about it, or your friends or family, like is it about that, or is it just maybe just not being decisive because not knowing how quickly you have to move in these markets?
I think it's a couple of things. I think it's one, not realizing like how quickly you have to move to impact kind of the longer term. Two, it's really hard. It's like
Yeah.
really personal. It's really hard. It's hard to sort of like look at names and like know faces and say
And friends
That's really
and
hard.
People
It's
you
really
brought
hard.
on. That,
And so sometimes anyways, it's hard.
Yeah.
And then I think the third thing is like, as you build a company, there's a certain phase when you're building your company where you say, okay, I absolutely have to hire this person or this terrible outcome is going to happen. Right? And so you hire that person, you're like, okay, that made sense. And then you start to kind of hire more and hire more and hire more. And that threshold to hire the next person gets lower. And so all of a sudden you're sort of faced with an organization that like everybody will say everything is really important what they're doing, but there is sort of like an overarching tax to having so many people in an organization.
Yeah.
And so I think it's if you go back to kind of the org chart with that fresh set of eyes and you say, okay, if I'm really being rational, what do I really, really need? That's one really also hard to do.
Yeah.
But you have to have like a different eye. You have to kind of take yourself back to a different point in the company's life cycle to apply that kind of high threshold.
It's like I used to always say, more people require more people.
That's right.
That's
That's
exactly
people don't
right.
realize the organizational cost of these linkages actually really, especially in many companies are remote, the tax is so high.
That's right.
And yeah, I think also it's tough to recognize when you're taking a step back. Maybe things were good, times were good at some point, and taking a step back is a hard thing too.
Yeah, it's hard.
Okay, so I want to go to the audience. I'm going to pass this mic around for questions. We're recording this session, I forgot to mention, with video and audio, and we'll make that available to everyone. But I just asked you to use the mic, not because the room's big, but for the recording. Do you want to start over here? Sure.
Thank you. This is a fascinating conversation. I'm curious if you can talk a little bit about your investment entry and the structure of how you do that. Are you typically coming in, cramming down the equity, or the existing investors sort of just walking away? Are they participating? How do you deal with management or employees in terms of motivation? Or is it just kind of wholesale change in organization and you have this hemorrhaging of both management, maybe intentional, and employees, those that you actually really do want to keep around? How do you balance all that?
I'll answer the really basic answer, and then you can follow it up with much more nuance, as is our shtick. I would say generally it kind of depends, but mostly it's like, what are you optimizing for, right? And we look at the organization and we say, if a lender just wants to be made whole and that's what they want to work through, then we focus on that. A lot of venture funds at a certain point say, I invested in this 8 years ago, I don't really care, then we know how to optimize for that. I would say we do everything from asset sales, we do a recap. We can be extremely creative in terms of how we actually structure, but you should give a better answer on that.
Yeah, I mean, it's going to depend on the situation, but absolutely existing investors are getting crammed down. I think, let me go to the management side. I'll come back to the cram down. For management teams and the teams in general, we're generally re-equitizing folks. So typically what we will see are companies that are no longer valued at what they raised at. And the liquidation pref plus the debt is a really big impediment for the management teams and the employees. I mean, if they were to sell the company for what it was worth, they're getting a zero today because there's 20 million, 50 million sitting on top in terms of liquidation pref. Maybe there's a 2x, maybe there's 3x. So part of what we're doing in this transaction, right, it's a puzzle, every puzzle is a little bit different, is we're bringing down that liquidation pref, right, in a recap and an asset sale, whatever the case may be. We're dealing with the legacy liabilities. So in cases, I mentioned, this $1 million a year lease, like, we don't want to leave that behind. Like, I don't want to assume that and pay that off. There might have been like failed M&A with the earnouts. Like, we want a fresh entity that doesn't have any of the legacy liabilities. And so that might change how we structure the transaction. Generally, we're looking to do an asset purchase. I would say it's just kind of a cleaner transaction. And then for legacy investors, once again, it kind of depends on, is the company worth anything? What's the enterprise value? It's not to say the company's not worth, it's worth zero, but if we have $4 million of debt that we're restructuring, but we got to carry, the company's losing $100,000 a month, like the legacy equity is just not worth as much, right? And so we try to balance, management team, lender, and existing equity holders to do a fair transaction. But ultimately, it's a tough conversation around the table.
But typically, I would say there's already tough conversations being had.
Yeah, that's
right.
right. Yeah.
There are already Sunday afternoon emergency board meetings like once a month.
Yeah. It's like how are we making payroll, right?
And,
Like that
and
conversation
so
already
it's
happened.
like investors are sort of like not wanting to pick up the phone or sort of like really reticent and not wanting to put more dollars in. And so we're already having hard conversations, and what we can offer is like a structure that gets us out, and we kind of do the best we can to make as many people happy as we possibly can that still stays within our mandate.
Thank you, guys. When you guys see like founders, investors, everyone and their mom kind of talking about profitability and reaching profitability now, do you guys see that as a permanent market shift, kind of everyone coming closer to honestly where you guys see value, or is it more a temporary counterbalance to the insane infrastructure valuations that everyone's seeing that are going to zero and everyone kind of reacting to that?
Well, I have a personal view on this, which is I think over the last decade, venture has become less venture-y. So when a venture investor is kind of looking at a SaaS company and looking at public market multiples, like something's gone wrong. Like they should be investing in that, recreating the woolly mammoth or a SpaceX. And those companies will burn money for years and years and years, but they're trying to do something that, is transformative, could be $100 billion companies. But I think what you're seeing, and part of like the ecosystem today, is that a lot of companies were funded that ultimately, unless they hit that escape velocity through lots of capital, sheer luck and determination, they had intrinsic ceilings to like where they could get to. And for most of those companies, profitability should have been on the roadmap probably earlier in the journey. I don't think that's the shift. I think the shift is that a lot of venture dollars started to go away from like the big bets.
I think also it's cyclical, right? It's sort of dependent on rates. I think like we're also entering a phase, right, where the hot thing in venture is something that's pretty expensive, right? And so obviously AI and generative AI, right? So I think we're gonna kind of quickly come back to a less of a focus on profitability.
Hey guys, yeah. So I have two questions. Like, if you're doing like an asset purchase, do you encourage existing investors to roll their equity over into the new entity? And if yes, do they need to put more money in? That's the first question. And the second question is obviously, what is the liquidation preference that you usually put on top of your capital?
So the first question is if there's value that's being provided to the existing equity holders. And many times there is, but sometimes there's not. We're generally not cashing them out. We would say you're going to get rolled into the new entity, and then if we're all very successful, there would be a nice recovery, and it'll be a better recovery than what you would have had if we just cashed you out. What was the second?
And liquidation preference is usually.
So the liquidation preference, coming back to my example earlier, let's say there's a $20 million liquidation pref today. As we roll in, and let's say we're putting in $3 million, liquidation pref is $3 million.
Oh, okay. So it's like it's usually 1x, 2x, 3x.
No, we want to align ourselves with management, so we generally don't go into the 2-3x.
Oh, okay.
There is structured capital that will come into companies. We didn't talk about this, but we don't come into that much competition with this type of capital. But there is capital that will come in and say, we'll keep your existing valuation, but we'll put in money at a 2x or a 3x liquidation pref. 5x we've seen in venture debt. The issue with that is it actually doesn't solve the fundamental problem, right? The fundamental problem is like the organization needs a rethink, and 2, you've just now increased the liquidation stack. If you went from 20 million, you take 5 with a 5x. Now you got a $45 million hurdle. Like, wow, that's really hard to overcome.
Really appreciate the conversation. I had a question about kind of aligned broadly to once a cram down or recapitalization happens, how do you incentivize the management team and or I guess more or less, where does the line for you guys acting as a venture firm / a traditional private equity firm start to happen where you bring in your own people and start to change management to create the organizational structure and align them to the goals that you guys are trying to deliver?
That's a great question. We re-equitize the team. We typically align vesting and equity and even cash bonuses around performance and time, so that we're all sort of in the same boat together. But making sure that great talent is well incentivized is a huge part of our strategy. So that's pretty meaningful. In terms of like inserting our own people, we tend to partner pretty closely with the management team. I would say like oftentimes, even before a transaction closes, we're sort of saying to the management team, hey, listen, you're doing 5 jobs. You should probably just do one of those. And we should like hire some other people to do these other jobs that you've never been trained to do but have picked up over time. Or kind of pretty open and transparent conversations with the management team about what we think the gaps are. And so usually there's like pretty good alignment there. And then oftentimes because we've done it, a dozen plus times before, we are leading those searches. We are kind of on the front lines of making those decisions, but not without sort of like shoulder to shoulder partnership with the existing team. We're not making decisions essentially without them, but it is sort of in it together.
Generally, just on that point, what we're seeing is companies, kind of have this entire suite of management. But where we see companies where we like the product and it's in market and it's doing well, we're seeing go-to-market teams that are failing, and so without a doubt, like that's something that we're kind of like keenly thinking about, like how do we fix that? But that's typically in concert with kind of the entire team.
I want to just do one last question, and then we have a little bit of time. We have the room till 7. And so there'll be time to ask individual questions. I'll go up here just because I'm lazy. Yeah.
Thank you. What form of exit do you guys looking then? It seems that you, if I'm not mistaken, your business model is more like a restructuring private equity, right? So then, what kind of exit do you look for? You expect to exit to be bought out by another company, or you also believe in secondary market exit? Meaning, like if the founder wants to keep the company private as opposed to, every time I talk to a VC, they always wants to go public, IPO all the time, right? So then I would have conversations with my friends like, well, what happens if I don't want to go public because then, they start playing with my strategies and things like that, insisting on very quick cash cow type. So the question is, what if the founder wants to go through restructuring, but they don't want to go IPO? Do you guys also look at different exits, like secondary market and things like that?
Almost all of the time, we're looking to exit to a strategic.
And a cash sale.
In a cash sale. So we're really not looking to IPO.
But is that cash sale meaning by any other organizations?
So when we are looking at companies, we're one of the things that we look for is that company in the path of consolidation. Are there natural strategic investors that would buy it? Oftentimes we talk to them and say, well, what do you need to see, and then really refine kind of where we're investing in the company and how we're growing. But yes, I mean we're looking to sell the company, whether it's a strategic or a financial buyer, for cash. That's good for us. It's good for management teams, and it's good for any other investor that's kind of has been.
In that case, if he's telling if somebody wants to go private to IPO, but there is no proven use cases in the market right now. So if you sell the secondary, what happens once the bubble goes up to 40B and 50B of any startup in the unicorn stage? At that time, VCs are very confirmed to go into IPOs. And then IPOs, if you're good and profitable and dividend making, Wall Street loves you. But if there is something missing in the data, then you're butchered in the day one, because your secondary will go to a level where you cannot expect. And when the founder puts 12, 15, 17 years of his life, that would be the best bad route. If you're not profitable or if you don't manage any Wall Street metrics, then the entire equation goes very wrong.
Okay.
Either you sell the secondary at 40B and cash out the money.
Okay, well, thanks everyone for the questions. First of all, I want to thank the Eisner Everett team and John and team. John, it's you, and we have Trey over here, right? Anybody else on your team here?
No, well, Patricia's out there.
Oh, okay, and then let's thank our speakers, Arun and Morton. Fantastic talk. And you